Ian, the perfect person to speak to today because of the links between fixed income and the open of these European equity markets and all of the selling of risk assets that we've been seeing. Underlying this run-up in yields that we have seen in recent sessions then, Ian, is there a we don't believe the Fed thought process running through this? The market is pricing rate hikes before the Fed has suggested they will come. So how do you explain that disconnect?
It's a bit of an interesting moment at what's going on at the minute, because historically over the last few years, it's been a case of the Fed outrunning the market when it comes to hiking rates. And obviously, as you said, we've got the complete opposite at the moment. I think what's really the market is focusing on is the fact that, we've got a lot of good news at the moment, as we've been mentioning over the last couple of weeks or so. The pandemic looks to be gotten hold of. The vaccine rollout seems to be a success at the moment. We've got cases coming down quite dramatically. And then we've got what is going to be a very significant fiscal package. And there's just questions about US overheating and people talking 6 or 7% growth. And if that's the case, does 1.5% on the 10-year look sensible? And I think that's what's really being challenged at the moment.
Yeah, we're seeing interest rate hiking expectations being pulled forward, aren't we, Ian? They're now at early 2023, so just in a couple of years. If growth is as strong, do you still expect then that the Fed will hold off from tightening policy?
So it's another good question. I think the data will be dependent on that. But I think that from what we've heard from the Federal Reserve over the last few weeks or so is they are very much focusing on their dual mandate of now maximum employment, as we listened to Jerome Powell over the last week or so, and inflation. And although we do know that inflation is going to pick up in the short term, and we're expecting to see 2.5–3% on the headline numbers in the second quarter, there is still structural downward shifts with inflation over the longer term. And I think it's those that they really want to see pick up, and they want to be convinced that inflation is going to be above 2% over the longer term before they move. So again, we'll have to wait and see on that. I think what the market is saying is that the risk is that does happen, just given the good news, given the reopenings, given the stimulus package, and the risk is that we get hikes from the Federal Reserve sooner than what they would like to do. I definitely think that's the risk, rather than waiting out longer at the moment.
Is this a test of the Fed's symmetrical inflation target, Ian? Is this all happening because we don't really understand enough, or it is still untested, this symmetrical target, the fact that they will allow the economy to run a bit hot, but we just don't know how hot and for how long?
Yeah, yes, it is. But also, in a sense, what was happening was probably what the Fed liked. And we heard from a number of Fed members over the last couple of days. They were looking at the rise in long-end yields and saying, actually, this is actually stating that our policies are working. We are seeing a recovery taking hold, and the curves were steepening. I think what was interesting yesterday was obviously the big move was in the 5-year part of the curve, so much more focused on the policy component. And I think there you've got the market asking that question. Are the Fed actually going to really allow inflation to run hot, run above 2% for a considerable period of time, or will they effectively, do a double take and start to hike rates when we get there? And I think that is what is challenged, because we've never seen this flexible average inflation targeting. If we go through previous hiking cycles where we started in December of 15, core PCE was making its way towards 2%. I think it was 1.6% when they first started hiking. We wouldn't have actually had a hike, apparently, under this new framework until March of 18. So I think there really is a question mark, and the market is sort of debating with the Fed as to what flexible average inflation targeting actually means.
Yeah, we're sitting here as we're talking to you, Ian, looking at the markets opening up 5 minutes into the European equity trading session, and European markets are under pressure, then risk assets coming under pressure. The stock 600 down by 1.7%. And this is the sector breakdown that we have. And interesting to see, it is no sectors are in positive territory for European equities on the stock 600, but the ones that are least hit today are the more defensive ones, the ones that are being sold off the most. Yes, technology is in there, but also energy and basic resources and travel and leisure. So some of the stocks, some of the reopening stocks, some of the cyclical plays that had been doing well as technology sold off are also under pressure today, and you wonder what that tells us about growth expectations. Where does this go from here then, Ian? I spoke to the Erste Bank CEO earlier on, and he was giving a corporate perspective on this and a banking perspective, and saying, look, he's just not convinced yet that this rally up in yields is going to continue. This sell-off on bonds is going to continue for much longer. What is your expectation?
I think there's probably three things that we're looking at as to what could be the circuit breaker that maybe stops this move higher. So, firstly, do those reflation themes go away? That, to be honest, seems quite unlikely given what's happening around the vaccine and the cases. The second would be, do central bankers come out and effectively put their foot down? And we obviously saw some big buying in Australia out of sync with their normal program. That hasn't helped dramatically. We haven't had the pushback yet from the Federal Reserve, and I think a lot of that's around what I would say is maybe the third thing that could disrupt this, which is, do we see a sustained sell-off in risk assets and a tightening of financial conditions? Because when we look at financial conditions in the US, they are exceptionally easy at the moment, and I know stocks have come off a bit in the last couple of days or so, but still positive territory on a year-to-date basis, having had a very good year last year. So I think there's still when the central bankers look at this, they will still see that they're not. What's happening at the moment isn't yet disrupting that dual mandate. Now, if we continue to see risk fall from here, then that will be a big question. But I think for now, probably the path of least resistance is for yields to move a little bit higher.
For yields to move a little bit higher, and of course they've come down from that 1.6 we saw yesterday. We're at 1.47 on the US 10-year. What about the steepness of the curve? The 5-year got a lot of mention yesterday. The 7-year auction got a lot of mention yesterday. I'm looking here at a chart of the 5-30-year. I'm wondering what that's telling me. What is the steepness of that kind of curve and the movement we saw in the 5-year yesterday? What is that telling us?
Well, we'll start with the 7-year. I think that obviously the auction was interesting, and to be honest, that is going to raise a couple of warning signs for Fed members and obviously Janet Yellen over at the Treasury, and they don't want to see those sorts of misses. So that will be a concern for them. I think when it comes to the curve, as I said, the steepening had been in line with what they were hoping for. It was highlighting that inflation expectations were picking up, growth expectations were picking up, and that their policies were working. Now, again, what happened yesterday is that the market pushed back on that and said, actually, it's all well and good with these growth picking up, but you're going to have to normalise policy sooner. And again, I think that's something that the Federal Reserve will be keeping an eye on, because they do not want the front end of the yield curve to move away from what they're expecting to happen and what they're telling the market is going to happen.